It's never fun to see markets wobble. The shutdown robbed us of visibility on the macro data. There's a bit of a tantrum the market's having. We're about to have a third year of double-digit gains. The S&P's up 80% over the past 3 years, and funds are measured on 3-year performance. Only 21% of fund managers are beating 80% over that 3-year period. It is one of the worst ever periods for fund managers, and so they'd rather see the market fall so that it falls to their performance level. I think what's more likely, of course, is the market follows a seasonal pattern, which means there's going to be a lot of chasing into year-end. To me, it makes sense that there's still a payoff coming. Institutional capital comes in, and JP Morgan, BlackRock are buying big stakes. I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. Every time we get a bit of a rally, there's some capital trying to be raised, and I think that's what's suppressing crypto for now. That's, of course, going to end soon.
Today, as the recent crash in crypto has investors worried, with Bitcoin falling below $95,000, as Ethereum remains below $4,000, the crypto market remains in limbo. As crypto investors continue to speculate as to whether we'll see a price drop in Bitcoin and Ethereum in the coming weeks, this crypto cycle is heating up, and Tom Lee remains bullish, with a parabolic rise in the last few months of 2025. Forced selling, leveraged bets, and the usual tug-of-war we see when an asset approaches such a huge barrier. The bigger picture looks very different, though. Analysts are drawing a striking parallel. Ethereum today may be in the same position Bitcoin was back in 2017, when it rocketed from $1,000 into the financial spotlight as Wall Street started paying serious attention. And just like Bitcoin back then, Ethereum is now catching the eyes of institutions, hedge funds, asset managers, and major investors who see its role extending far beyond speculation. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. The community is buzzing, and adoption is spreading across industries from decentralized finance to stablecoins. Even the regulatory environment, often seen as a stumbling block, may be tilting in Ethereum's favor. That makes Ethereum more than just a digital currency. It positions the network as a backbone of future financial infrastructure. And as Tom Lee points out, this is likely just the beginning. With Wall Street's deeper involvement and retail energy still strong, Ethereum's growth story has room to run. The question now isn't if Ethereum will climb higher, but how fast it can write the next chapter in crypto history. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
Ether's down 8.5% this week. Bitcoin's down 8%. BitMine is down 20%. What's happening here?
Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Can crypto treasuries, like yours, for example, can they trade as well or in tandem with a cryptocurrency itself, or does one have to trade at the expense of the other? If I'm going to see money flow into Bitcoin or crypto treasuries, wouldn't it then come out of the actual pure play coin itself?
Not exactly, Scott. For instance, when BitMine has shareholders and institutional capital comes in, and JP Morgan, Invesco, BlackRock are buying big stakes, then that capital is then used to buy Ethereum. So it's actually going back into the ecosystem, but then it's going into a vehicle like BitMine that's actually a permanent holder. BitMine owns 3.5 million Ethereum, more than 2.9% of the supply, but now that is not going to be subject to liquidations because there's no leverage used to hold that Ethereum. And then at some point, that 3.6 million or 3.5 million Ethereum is going to be staked and then generate nearly $400 million in net income. Well, that can create returns for shareholders. So in a way, a crypto treasury is actually a pretty attractive equity because there's an income component, plus there's, of course, that ability to grow your Ethereum holdings per share.
What if crypto treasuries become more favored than crypto itself? There's no negative impact for either the way that Ether or Bitcoin would trade if just more money floods towards the treasury part of this story?
Well, one, it's a conduit because, as you know, equity managers, many of them, the 4,000, can't own crypto directly. So they have to get exposure to Ethereum by buying a stock like Bitmine. And Bitmine is the 438th largest stock in America today. It's not that different than if someone wanted to have exposure to energy, they can buy oil and trade a commodity, or they can take like oil barrels at home, or they can buy an oil-related stock, either a major or something in the supply chain. That's what crypto treasuries are, is essentially an asset class that gives you direct exposure to the crypto asset.
All right, let's pivot to the market itself. Is your confidence at all shaken in where we are and what you thought the prospects for an end-of-year run could be?
Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. But it is consistent with the idea that, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAII went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. In fact, maybe over 7,000 by the end of the month. The things that really matter. We're trying to change the way people invest in terms of thinking not only about long term, but we're really trying to get people to think about the super cycles. The super cycles are intact. So that's why we're not worried. There are walls of worry growing. That's what you're going to hear from folks, and those are going to give you chances to buy stocks. And thirdly, just keep in mind the risk reward's positive. I'd say that we still think November's going to be an up month. With a lot of confidence. And the first reason for that is that stocks are up 6 months in a row, and it's almost going to strengthen the case for November to be positive. But we know it's going to be choppy. We think it's a choppy first 2 weeks, but then we ultimately end up, over 200 points on the S&P. That would take us past 7,000. And these are the 6 years that I think are precedent markets. These are the times where the markets were up May through October. And you can see that the November to December, which is far on the far right, has been positive, except in 1936 when the markets basically were flat.
Ethereum isn't just holding its ground, it's starting to pull ahead. As 2025 winds down, Ethereum has actually outperformed most other major crypto assets, driven by record on-chain activity, surging developer adoption, and growing institutional demand. While Bitcoin continues to anchor the market, Ethereum's momentum is signaling that it could be a real leader in this next phase, setting the stage for what analysts call its strongest run yet. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
I think we're in a very different place. That was post-depression period. We're really in the middle of an upcycle. I still think we're going to be at least 7,000 by year end, maybe 7,300. And if you think what's late cycle, just keep in mind that ISM is still below 50, 33 months now. We've never been top of the market when the ISM's below 50. I think we're far from a bubble today. Margins are expanding, and I think it's very telling because earlier this year, you remember the consensus from the Fed was that someone has to pay for these tariffs. So inflation would go up and margins would get squeezed. But in the third quarter of this year, which is in the full force of tariffs, companies taking 67% of that hit, earnings grew faster than revenues. 7 out of 11 sectors had margins expanding. And there's a fund manager chase that's going to happen into year end. So everyone will say, you're going to hear someone tell you, everyone's bullish, Tom. That's not true, because if they were bullish, their performance would be outperforming the S&P this year. And as you can see, 22% of active funds are trailing their benchmark this year. So it's been a bad year for fund managers. And now we have this huge wall of worry. And this is what I think we have to be working our way through. The second wall of worry is the Fed's hawkish. And this is where I think the Fed may be misreading some of the incoming data. Now, we know that there's a new Fed chair contemplated, and it's down to 5 candidates. And what I find interesting is that Fed fund futures, okay, the number of cuts in 2026 has not priced in a new Fed, because as I've highlighted in the shaded area red, that in May of this year, Fed fund futures was pricing 2.6 cuts for 2026. And this is at a period when a new Fed chair was talked about. And yet the number of cuts has actually stayed at roughly 2.6. In other words, the bond market has not priced in a dovish Fed. It's actually pricing in the same Fed that has made a hawkish cut in October. And why is the Fed saying December is uncertain? I've highlighted this before. They've talked about the fact that the neutral rate is still being debated. But keep in mind, the neutral rate is dependent on long-term inflation. So the Fed's basically saying, we're not cutting because the neutral rate might be higher because we think there's more inflation. I think it is helpful to think about where we are in the cycle. I know the Fed is a little hesitant the reason to cut in December, but the reason they're hesitant to cut is the economy is actually pretty healthy, and they just don't have a clear contour of how quickly inflation's cooling. That's a very good backdrop for corporate earnings, actually even corporate earnings to actually start to spread. So if the Fed gives us some guidance and visibility about, path forward, I do think business confidence picks up. That means that ISM starts to recover, and it is a broadening trade. So I would agree with the other speaker that, I like tech structurally because of AI spending, but there's still plenty of room for the small caps to work, which have really taken it in the gut as the Fed's sounded hawkish, and the banks. And so I'd be in sort of favor of a broadening trade as well. But I still like tech. And as you know, the AI trade comes under question every few months. There's always a big pullback. But for the last 5 years, investors have had to buy that pullback. I think from a market's perspective and from the economy's perspective, we know that high rates are actually causing, something that I think the Fed actually has some can actually have some impact on. So I do think it makes sense for the Fed to cut.
Where does all of this leave us? Ethereum has crossed $4,000, weathered short-term volatility, and is now attracting the kind of institutional attention that once catapulted Bitcoin into the mainstream. Analysts are increasingly framing this as Ethereum's 2017 Bitcoin moment, where the groundwork laid over the past decade finally meets global recognition and capital inflows. But here's what makes this cycle different. Ethereum isn't just competing as a digital currency, it's the infrastructure powering decentralized finance, stablecoins, and entire ecosystems of applications that regulators and institutions are beginning to take seriously. That combination of utility and adoption is exactly why many see $5,000 and beyond as not just a price target, but an inevitable milestone. Over the past year, Ethereum has quietly outperformed most other major crypto assets. Tom Lee and other top analysts emphasize this point. Ethereum's real growth story is still ahead of us. With Wall Street leaning in, developers innovating faster than ever, and adoption spreading across industries, Ethereum is positioned to be a defining force as we head into 2026. The bottom line: the short-term swings may grab headlines, but the long-term trajectory is unmistakable. Ethereum is evolving from a promising blockchain into a cornerstone of digital finance and technology. And if history is any guide, the breakout we're seeing now could be just the opening chapter of Ethereum's biggest run yet.